All right, we're coming into the final segment of the show. It's called the Business to Business Network Show. My name is Rex Perry. If you miss anything, go to our website, 123B as in business, Z as in zebra.com. And our co-host is
Jeff Obrasky, Homeowners Financial Group.
We've been doing a little bit of a reunion show today, talking to agents that we had on last year, and boy, things have changed. What do you think about happening in the interest rates and with the Fed?
The Fed and interest rates. One of the
Janet Yellen.
Janet Yellen was very, very dovish yesterday. Everyone expected her to take the word patient out, and she did, but then she laid out about three other milestones that need to happen before interest rates go up, which include the job market getting even better, and that inflation show that it's moving meaningfully towards 2%.
Yeah.
Well, the market looked at that and they said there is no inflation. So this could be months, if not longer, before they raise again. Now, they did the way they structured it. They now have the ability, now that patients go on, to raise at any meeting they want. Mm-hmm. Okay, I think that people forget the stock market for a minute, because the short-term interest rates in the stock market can have some sort of a link. But they need to understand that historically, when the Fed starts raising rates, it's when the economy's getting overheated. Mm-hmm. Okay? And inflation's starting to grow. And, the only thing worse than deflation in our economy, which is the worst thing, is runaway inflation.
1978. Okay. I remember.
I remember the gas lines.
This just shows how old I am, but I was in those gas lines.
And inflation's like a battle carrier. It's one of the things they say. It's really hard on the water to get started, but you get a battleship going at 30 miles an hour, they put on the brakes, takes like 10 miles before it stops.
That's right.
I mean, literally, you can't stop it that easy.
Right.
So in historical environment, that when the Fed starts raising, it's usually a fairly long number of hikes, which eventually will usually slow the economy down either to a crawl or even put us into a mild recession. Mm-hmm. Okay.
If it overheats.
Well, to prevent it from they'd rather a mild recession from, it's kind of like when the pot starts boiling.
Yeah.
Okay. Sometimes you got to throw a little cold water in it, and you might to simmer it down. And if it means you got to wait a couple of minutes and start it up again, that's better than having a kitchen fire.
Yeah.
Exactly. Okay. So this time is different. This time is going to be way different. No one has any idea of when they're going to raise, how often they're going to raise. But this is going to probably be a raise once. They may sit for 6 months or a year. We are not in a runaway economy. We have zero inflation. Okay? It's just a question of should we still be at zero interest rates. Secondly, the Fed raises short-term rates. It's the only rate that they have any control over. Mortgage rates have nothing to do with short-term interest rates.
Right.
Mortgage rates have to do with medium to long-term interest rates.
Right.
Okay? And the bond market is driven much more by inflation fears than it is anything. So interest rates on mortgages are only going to go up meaningfully. When I say meaningfully, we're at, let's say, 4% now, 4 to 5%, that range. Okay, historically rates are 6 to 8.
Yeah.
So when I say meaningfully, I mean the only way that interest rates are going into the 5s or towards 6% again is if we have a serious inflation issue.
Right, which we don't look like
and a seriously overheated economy and wage inflation, etc. Now, between here and there, if we get there, guess what's going to happen to the price of your home? It's going to go through the roof.
Yeah, go up.
Okay, won't be a bad thing. Interest rates going up are not a bad thing.
No.
The strongest housing markets historically accompany the strongest economies, because how much people make dictates, and how confident they are that they're going to continue to make that amount of money or more money is what drives people to buy homes.
Exactly.
And household formations. And that's when the economy gets stronger, guess what's going to happen with the millennium? Gen, what is it? The millennials. They're going to move out of mom's house because they got a good job.
Time
and
to
the
go.
girlfriend's going to finally say,
we better get married.
We've been together for 16
Community
years.
property state.
They're going to move out. They're going to start forming households again. They're going to have kids. They're going to do the whole thing. So I think stop paying attention to the Fed.
And don't panic.
Don't panic. Ironically, rates went down 1/8 of a point yesterday across the board.
Yeah, for long-term rates.
Okay, for long-term rates. We had a huge rally in our market. So I think there's this tremendous misconception on interest rates. Don't worry about the Fed. The Fed is unquestionably your friend. They're not perfect. They've made mistakes, but they're here to make this economy. And you want a little bit of inflation.
Yes.
A couple of percent. It's a good thing.
Yeah.
Okay? Your house goes up when there's inflation.
Yeah, we want that. Now, you got a loan program we got to touch on.
We do. Okay. There's a renovation program out there, and we get asked a lot. Everyone's heard of the FHA 203K. Okay, and realtors don't like it. They don't like to talk about it. One of the couple problems with the 203K is you're limited to a $271,000 loan, and you're kind of limited to $30,000 in repairs. So Fannie Mae has a program out there called Fannie Mae Homestyles. Mm-hmm. It's a very open-ended renovation program. So number one, you can borrow as much as $417,000, which is Fannie Mae's loan limit. Number two, okay, you can borrow up to 50% of the value of the home for renovations, which means you can buy a $250,000 house that's 40 years old, that the bones are great, the neighborhood's great, the yard is great, but it hasn't been touched.
Yeah.
And you can do $150,000 of remodeling. You can do the flooring, the kitchens, the cabinets, everything. You can put a pool in. You can do landscaping.
And roll it
all into a 30-year conventional mortgage.
With incredible, still low rates.
Then the rates are fractionally higher than a regular loan. So let's say you were at 4 to 4.25 in a conventional loan today, probably 4.25 with 5% down. You'd be 4 3/8, 4.5. Modestly different. Okay. But you can do, there's a much higher ceiling in terms of how much money you can borrow, how much money you can actually put into the renovation. FHA doesn't allow you to do pools or landscaping. Mm-hmm. So a lot of people go and say, well, I want to get a pool loan. That's fine. You're going to borrow $35,000 at 7% payable in 9 years.
Why?
Or you could borrow it at 4.5% over 30 years. Your payment's a third.
Fantastic. Thanks so much, Jeff. We got to wrap up the show. Go out and have a great Saturday. 123bz.com is our website if you miss anything. Thanks for tuning in.